All right. So what are we doing here today, right? I mean, we're here to chat and talk a little bit about the one word Andrea said earlier, which was volatility. She heard an article about volatility, or I should say, she read an article about volatility. Um, you know, in the Wall Street Journal recently, right? That's like the buzzword of the year, right? Volatility. I think the buzzword of last year was transitory. Um, Buzzword of this year is now volatility, and then of course inflation. But we want to address it for a lot of different reasons. We want to address it because, believe it or not, as painful as it seems, pretty normal. And not certainly not trying to downplay it, but we're going to explain to you why it is normal and show you exactly, how things react to it as time passes by. But before I dive into those items, look, we're fortunate enough here to always bring an expert, in our opinion, on the line. So, and today we have Kevin Golden on the line. Kevin is a partner of ours. He's been a partner of ours for, for as long as I can remember. He is a regional director over at Franklin Templeton. So if any of you know Franklin Templeton, I'm sure you do. They are a 100-plus-year-old investment management firm that now can, basically facilitate just about any and every investment sector that's available in the marketplace today. So bringing him on the line to kind of talk a little bit and answer some questions, to me is an added advantage. And I think that, he could shed some light maybe in a different way than Lou and I can. And then it's, it's also just you guys hearing it from a different voice and a different, different perspective. So Kevin, I thank you for being on the line today. He's got another meeting that he's got to get to at 5. So we only have him for about another 10 to 15 minutes tops, if that. So why don't I toss it over to him for a few, maybe, have him, say a few things about volatility, and then maybe answer any questions that those that are currently on the line may have, and hopefully those that come on the line shortly.
Great. All right. Thank you, Anthony. Let me just jump right in. Couple of points that I think Anthony just made, I want to echo. There is some normalcy to this. It just always seems in modern times that everything, the words I hear a lot are, oh, it's so crazy these days, or there's so much news and noise. And the reality is we could all be on the phone here on a call like this a year from now, and I guarantee you there'll be a number of things that everyone's worried about. The one, and the word we can't use a lot in this business is guarantee, but I guarantee there will always be something to be worried about. I promise you that. Okay, that's just the nature of the world we live in. Something economic, something political, something global macro, some country that we're having a conflict with. There's always going to be something. And it makes investing hard because the investing world, touches everything to a certain degree. But I think the one thing that I don't think, most investors sitting at home watching news get is the reality of the fact that what Anthony and what Louis do every day for you, financial planning, is really the key to everything. Because you can stomach volatility in your investments as long as that's not money you need next week, next month, next year. And it's not so much about your age. I know the age-old thing is, well, as you get older, you got to be more conservative with your investments. Yeah, that might be the case. But the reality is, regardless of people's age, if I know I need a certain amount of cash flow over the next, let's call it 2, 3, 4 years, that money shouldn't be exposed to any investment that can go up or down substantially. So I hope everybody on the line follows me there. I don't think that, Fox News, CNBC, you name it, and this isn't to pick on the media. I just know that, there's tens of millions of people every day that listen to the news about the markets and everything else. I don't think that they're saying that enough. That, hey, this has been a terrible year to date for the stock market, the bond market. We know about inflation, interest rates, et cetera. But I don't know that they say enough, hey, Mr. and Mrs. Investor, by the way, if you have enough cash flow to live your life for the next couple of years, hang in there. So I think that's really, really important that we say that. Market volatility does happen. As Anthony said, and I'll share my screen here quickly, if that's okay. I pulled up this chart. Hopefully, can everybody see my screen? Just nod, give me a thumbs up, something. Okay, cool.
Yeah, we're good.
This is just age-old charts that our people in our industry know well. This is the S&P 500, just using it as a proxy for the equity markets. And this is going back over 50 years to the early 70s, and all these little writing that you can't read that well on the screen. It's just some major things that were happening in the world negatively that impacted the economy, that made people fearful. And you see a lot of little blips. The equity market is for longer term money. And I'll reiterate, even though I kind of said it before, when I mean longer term money, I just simply mean money that you will not be spending the principal over the next at least few years. That's a personal conversation to have with your advisor, with Anthony, with Louis, about, what is my spending habits? The most important part of a financial plan is, what is my spending habits? How much do I need to live the great life that I want to live? And what liabilities and what payments do I have coming up over the next couple of years? But what you see here again is a stock market that over time goes up. We're going to have bad periods. It always happens. There's always different reasons why it happens. I don't want to spend a lot of time on this call of why it's happened. We know it's regarding inflation. We know it's about interest rates. And as inflation over the next couple of quarters starts to level off and become a little more normal, when I say normal, I'm not talking about the normalcy that, well, let me say it differently, the low, incredibly low inflation that we've had over the last 10 to 15 years. I'm saying a little more normal historically, 3%, 4%, stuff that we could live with. You'll see the stock market stop falling so violently. I think a couple of other things on this brochure that I think are interesting, as Anthony said before, there is some normalcy to volatility. It does happen. I'll blow this up a little bit on my screen. Pullbacks are normal. Market declines of 5% on average have happened every 9 months, 10 every 2 years, 15 every 4. So far year to date, and we're only 5 months into the year, depending on what index, what part of the equity markets, we have markets down more than 20. Some of your accounts are probably down 15, 20, possibly. And that does happen. Okay, it happens more infrequently every 8 years. The big ones happen, more infrequently, but they do happen. And good financial planning, I know I'm being repetitive, but I cannot say it enough, allows you to stay in there. This next chart is vital too. It's the time in the market, not timing in the market. I know Louis and Anthony and Andrea have probably seen this one before, very popular, but this is just simply saying, hang in there. Okay, it's about staying in the markets. If we had a crystal ball and we knew on January 1st of this year, hey, the next 5 months are going to be really ugly in the markets, get out, well, that would have been great. But the reality is most of us don't get out, and we can't get out. But if you just hang in there, this is just simply saying average annual returns, the longer you stay in, the less likely it is that you're going to be down in a market. So just hanging in there. And I have a lot of pieces like this that just talk about staying in the markets and the key to just, even during the worst of times, the best and the most important role that your financial advisors play is that ability for you to call them and be open and honest. Do not hold back. I tell my own parents this for years. Whatever you're worried about with your own money, say, Anthony, Louis, I am scared. I can't sleep at night. What can I do? But you got to utilize the greatness of your financial advisors, and you can get through this. So, I'll just conclude again that the word of the day is volatility. Volatility is here. It's always here. Sometimes, it gets quieter. It will get quieter soon. It always feels like, whatever time we're in right now feels like it's lasting a long time. This will pass. We're very confident on the economy going forward. And markets are very, forward thinking. What does that mean? As I conclude here, that means that a lot of bad news gets priced in very quickly into the market. I get people saying to me, isn't the Federal Reserve going to keep raising interest rates? Isn't that going to keep affecting the stock and bond market and real estate and other markets? The answer is yes. But a lot of the expectation of higher rates and continued inflation is already priced into assets. So that's the key to just kind of hanging in there. But we are here to hold your hands any way possible. So I'll just pause for a second. Comments, questions, anything. I got a few minutes. I can hang on here. I got to jump around 5:05 or so to physically go to another meeting that I got to be at that's just down the road, 5:30. But anything at all that I could, further comment on.
No, pretty straightforward, pretty good summary by all means. I mean, look, You mentioned, well, we don't need to necessarily talk a little bit about the why, right? I'm going to touch on why some of these things have happened this year, right? I mean, if we could kind of summarize it in one
Sure.
word, that word is uncertainty, right? I mean, we could absolutely dive deeper into the weeds, but the reality of it is the markets, they just hate uncertainty. And there's just quite a few things out there that are a bit uncertain, right? I mean, well, right, we started off, I should say we wrapped up 2021 with the uncertainty around the ending of the pandemic, which arguably at the end of 2021 seemed like there was no end in sight, right? I mean, we were dealing with Omicron, okay? Nobody and just about everybody you knew had COVID, and nobody was showing up to work. So now, in addition to the lack of labor supply that we've already had over the course of the past several years, we're dealing with individuals that can't go into work because they're unhealthy, right? So that was what we call whammy number one. And then we were still dealing with the effects from the onset of the pandemic, the supply chain disruptions. Nobody knew when these were going to subside, and some of them still haven't subsided. So you had uncertainty there. And then it's segued into, well, guess what? Now there's not enough people, looking for jobs, and there's more jobs that are available. So on one hand, that's a good thing, right? But because you could say the economy is really strong, but on the other hand, it's not going to do anything for the supply chain disruptions and the labor shortages, right? So I mean, there are 2 jobs open for every 1 person looking, on average. So conceptually, for sure, our economy is doing well, and that is a very good thing. But there's just uncertainty surrounding it. And then you fast forward, early in 2022, everyone started to talk about inflation, and we saw inflation creeping up pretty dramatically, and that's a scary thing. And we all know now it's not transitory, and it is a real deal thing, right? I mean, I went to the supermarket yesterday. I didn't even fill my cloth bag, and it was like $85. I had like 4 things in it, and it was like, okay, it's a real thing, I mean, every time my daughter eats cereal like 4 times a day, and I cringe because I'm like, here we go, here's I got to go to the store and buy another box of cereal, and sometimes you don't even see it, right? The price might not change, and we call this skimflation, right? I mean, the price doesn't change, but if you compare a box of cereal from 3 months ago to a box of cereal from now, you'll realize that it's like 6 ounces less, so you're getting less for the same price, right? But so it's technically still inflation, but sometimes you don't even see it. So that's an issue. There's uncertainty there, and as a result of inflation, we have rising interest rates, right? How far are they going to go, right? I mean, when are they going to stop? There's uncertainty there, and then you throw this whole big, 800-pound gorilla in the room, of a geopolitical event and a war, and it exacerbated everything. So look, I mean, the bottom line. The one thing that markets do not like is lack of clarity and uncertainty. And we've just had I just listed about 3 or 4 things that are still unclear, right? We don't know how far or how high rates are going to go. We just don't, right? We have some good inclinations and some good guesses, and I'm going to show you a couple pieces that talk about how the market reacts to rate hikes and what happens, 3, 6, 9, 12 months down the road. But the bottom line is right now, we just don't know how far it's going to go. Inflation. Our feeling is that we may have peaked, but we don't know that for sure, right? Our feeling is that supply chain disruptions are going to be, are going to slowly but surely resolve themselves, but we don't know that for sure, right? So again, a lot of things that still remain unseen, and I just want to pause there and see if there's any specific questions, around what I just commented on, or I'll share my screen and show you a few charts on what I just commented on. Nothing? All right. All right, so let's talk a little bit about interest rate hikes, right? Let me open up a few things on my screen here. I'll share it and we'll go from there. All right, so everybody can see my screen, I assume, right?
Yes.
All right. So interest rate hikes, right? One of the big uncertainties that we have in the world or in the market right now, and this is one of the things that are affecting the market itself, right? I mean, inflation obviously was the cause. The result or the impact are inflation or interest rate hikes. Yeah, undoubtedly, interest rate hikes tend to have a somewhat negative impact to the equity markets right off the bat. I mean, obviously, interest rate hikes are going to have a negative impact to fixed income because, fixed income has an inverse relationship, right? As when rates rise, price of bonds declines. So we know that. But how does it impact the the S&P 500? How does it impact the equity market? Well, initially, right, roughly around half, a little bit more than half of the time, there's a negative impact to the market over the ensuing 3 months after the first Fed rate hike. Now, mind you, we had a first Fed rate hike about a month ago. Okay. 6 months later, 9 months later, over 85% of the time, markets are positive, and in many instances, on average, they are positive over 10%. So, look, these are just the most recent interest rate hike cycles that we've been through, but there's many, many more that going beyond that, and the statistics are still the same. So the reality of it is, I can echo some of the things that Kevin was saying. This becomes a waiting game, right? This becomes a waiting game as far as how historically markets have reacted. And what I can tell you is this: history is not going to is not going to repeat itself exactly, but history will rhyme. And right now we just don't see markets reacting in a completely abnormal manner to what's happening at the moment. Does that make sense? Okay, next one, right? Talking about all the whammies that we just discussed. This isn't from me. This isn't from LPL. This is from Vanguard, right? Vanguard obviously is, a do-it-yourself investment firm. Everyone says, well, things are different now. We're in the middle of a war. And I say, okay, yeah. We've had wars before. We're going to have them again. We've been down this road before. We're going to be down this road again. What typically happens? Just like interest rate hikes, the initial impact of a war, right, or any geopolitical event for that matter, is negative, right? The first initial impact is negative, which is the orange lines or brown lines, and then the other two lines that you see are 6 months and 1 year later, right? There's only been, of the most recent, geopolitical events that we've had going back to 1960. I mean, this kind of echoes Kevin's, chart before. There's always a reason not to invest, right? I mean, geopolitical events could be, certainly could be one of them. But if you notice on this chart here, there's only been one time in going back to 1962 that 6 months, 12 months later, markets were actually negative following a geopolitical event. Can anybody tell me what the difference is between that one event that you're seeing on this page here versus all the others? Anybody want to go out on a limb? Not Lou, not Kevin. No? All right. Nobody wants to raise their hand. Listen, the bottom line is, if you look at the 7 other events that are on here that are all positive 6 and 12 months later, they're outside the borders of the U.S. Bottom line, right? There's only one that was inside the borders of the U.S. So yes, when we have a geopolitical event outside the U.S. borders, the impact is certainly going to be negative at first, which it was. 6-12 months later, market digests, things become a little bit more certain and clear. And believe it or not, markets actually generally react favorably as a result. I see Andrea unmuted herself, so she might have something to say.
So yeah, but the Ukraine conflict is still ongoing. So, how do you measure the 6 months? I mean, it could go on, I don't know.
It can go on indefinitely. Yeah, go ahead, Kevin. I'm sorry.
No, I was just going to say, Andrea, you're absolutely right. But as I said earlier, Andrea, and Anthony and Lou know me well, I'm a very positive, optimistic person always, but I'm also a realist. There will always be things to worry about in this world. And like all of us, we all hope that that conflict just ends for so many reasons and ends right now. However, unfortunately, when it does end, there'll be something else to worry about. That is just one piece of, these negative factors, wild cards that are always out there. But, unfortunately, I hope I can say this on this call, the world has to adapt. We still get up every day and we go to work. People still get up every day and spend money, and the economies continue to go. So you're absolutely right. That conflict can go on for a lot longer, but that doesn't mean that the markets don't recover quickly. And I love this slide because what it really shows you is that, yes, markets go down, but they also recover fairly quickly. As you were, I'll show you something after if you want to give me, I think that it's such an important fact that even this year, we're only at the end of May, we're in June already now, the markets can recover substantially even this year. I have a chart I could show of intra-year returns where markets could have really bad January to June, and the next 6 months can be really good. And you're right, no one knows when that conflict, but I am not downplaying that conflict at all. It's horrendous for so many reasons, but markets do recover. I mean, we don't have to revisit history, but there's so many times. So you're absolutely right. It's a question that can't be answered. But I'm trying to help maybe just that mindset that there will always be something that we're going to be concerned about, and that's our jobs. And that's where it comes back to that financial planning. We always have to control what we can control personally, which is our own personal ability to spend and incorporate in, inflation, such a big part of it. Yeah, there you go. This is the chart I wanted to show the intra-year.
Yeah. So yeah, I mean, we had it, wanted to talk about it, right? So this kind of supports the fact that, believe it or not, what's happening right now is normal, right? What was somewhat abnormal was essentially what happened in 2020 and 2021, right? Just essentially a straight market up or straight shoot, straight shot, to the sky. What this is kind of showing you here, if you look at the green line, those were the intra-year highs, right? So the orange lines were intra-year lows, and then the gray lines was where we finished for the year, right? So if we look at the S&P going back to 1999 to 2021, and we have, we can certainly go back even further, but again, history will rhyme. On average, you see some pretty large intra-year declines: 19%, 10%, 12%, 18%, 15%, 27%. Let's take this one for example. These two are pretty close to where we were, right? I mean, at one point the S&P was down, 19.7%. We were 0.3% away from a bear market. We actually crossed over bear market territory intraday, but we didn't close in bear market territory, right? So let's, markets finished positive for the year, 2.1%, right? I mean, obviously we know 2020, that was a bit of an anomaly. We were down 34% almost. We finished up the year 18%, the year up 18%. At one point it was up over 70, but on average, you can see there's some pretty large declines here. And more often than not, right? More often than not, do we actually finish negative? Now, the two instances that you see on this page that did actually finish negative, there's three, basically three instances that finished negative. I'll call them 1, 2, and I'll group these three together, right? So 3 instances. Anyone want to guess what the similarities between these two are? Well, it's a big word that everyone's talking about. It starts with an R, right? Recession, right? We had a recession, right? So, on average, I got another piece I could show you. I didn't actually pull it up for today, but on average, pullbacks or corrections minus a recession usually range between 18 and 24%, and then they recover within 6 to 8 months, right? If we have a recession, obviously that's going to be a differentiator, and that is another big uncertainty that's out there in the world today. But that's the big, that's the outside of this 2018, right? These other two instances right here, we had a recession. In fact, this was a big financial crisis, right? Does that make sense?
Anthony, could I jump in? I just have a few more minutes. I wanted to just point out a couple things. Is that okay?
Yeah,
can I share my screen?
Yeah, go ahead.
I just have to. Yeah. So let me ask everybody a trivia question. I know some of you are shy. Andrea's the least shy, so maybe she'll answer. What's the percentage over the last 85 years? 85 years. Obviously, 2022 is not in the books yet, so this is as of the end of last year. For the last 85 years, what percentage of the time, and again, we're just using the S&P 500 as the U.S. equity market, what percentage of the time was the market up versus down? The answer is kind of on this screen right here that I'm sharing. If you did the quick math, anybody know what percentage? Take a guess. It doesn't have to be Andrea. I was just picking on her because she actually spoke up. Come on, throw out numbers. And you know what? It's also going to show whether you're a very positive person or somewhat of I don't want to call you negative. That's not nice, but, pessimistic.
80%.
All right. Whoever said that, I think that was Lou. You're very close. You did the math. Lou's good at math. It's 76% of the time over the last 85 years. That's just simply 65 positive years and 20 negative years. Again, our industry is always guilty of, we always talk long-term. Everyone says long-term, and there are a lot of people who say to me, long-term, I don't have long-term, or I don't want to think long-term. But still, this is why we say, yes, the equity markets are really good markets. And I know I'm just focusing on stocks here and, bonds or something else. But yes, the equity markets are great places for long-term money. And when I say long-term, I'm not talking about 5, 10, 15 years. I'm talking about just hang in there. There are some bad years here or there. But that's what this is saying. The average annual return is 10.7%. You compound that over time. That's really good. And you throw in these bad years like we're having so far this year. And as Anthony just showed, that doesn't necessarily mean that 2022 is going to be a bad year. But yeah, 76% of the time. So I got a little bit of a time horizon for that piece of money. I always say, and I know I keep going back to these financial planning kind of lessons, everybody's got their 0 to 2-year money, their 3 to 5-year money, their 5-year plus money. And if you think in those terms, certainly that 5-year plus money can be an equity market. So I think that's one key thing. And I just wanted to, show one other thing, since the key word is volatility. Might as well use a piece that uses that word. 5 things you need to know to run a follow stock market. And from the sidelines, it cost you. I know every day Anthony and Louie are hearing people saying, hey, why don't we get out and then we'll get back in? It's not that easy. If you stayed fully invested in the S&P 500 for the last 20 years, that's a 9.52% return. If you missed the 10 best days, and that's not the 10 best days, I'll make this larger just so everybody can see. That's not the 10 best days per year. So we're talking about 20 years worth of performance. If you miss the 10 best days, remember the stock market's open roughly 265 days a year. If you miss the 10 best days over 20 years, you go from 9.52 to 5.3. You see the rest of this chart. Miss 20, you miss 30, you're basically flat. So Warren Buffett doesn't try to get in and out. I don't know him personally, but I can just say that, read enough. That's not what he's trying to do either. None of us know when those bad days are coming. I know that there are plenty of people who say, well, what if I missed the 20 worst days? Sure, that'd be great. But the reality is oftentimes the worst days in the market, the recovery day sometimes is even the next day. We saw that a lot in 08, 09. We saw that a lot in 2020, with the COVID recovery. So, just hanging in there. A couple of other things, dollar cost averaging. That's simply, if you had some money to put to work today to invest, you might say, hey, it's been rough. Do we wait? Well, maybe you put a little bit in today. Maybe you put more in a month from now, 2 months from now. And that's a really good way to invest. You're not trying to pick the bottom on anything, whether it's an individual stock or a particular investment. Dollar cost averaging is always a great way to ease into the market scope of volatility. It's always good to do a portfolio check, because I think there's people who say, wow, I didn't realize that fund or that investment or that stock or that bond or whatever it is that you're buying can be that volatile. I think it's important to get a sense of, hey, is this appropriate for what I do? Believe your beliefs and doubt your doubts. I'll just conclude with that. That's something that our founder, John Templeton, was famous for saying. If you believe something strongly, whether it's your whole life or even, we're being tested right now. It's June 1st, and a lot of investors out there probably sat down with their financial advisors in November, put a plan together, put some investments to work, and 7-8 months later, they're already doubting, was this a good idea? Well, if it was a good idea in November, it probably is still a good idea today. Believe your beliefs and doubt your doubts. Try to avoid the negativity. Try to just, believe in the investment principles. Anthony and Louis don't pay me to say this, but you have two incredible financial advisors that have your best interests at heart always is the number one thing that they do. So I can't say enough, kind of stick to what you do. So I'll just conclude there. I wanted to throw these pieces in. I thought they were pretty appropriate for the conversation. Anything anybody can throw my way, questions, hard questions, anything at all I can do to make everybody's day better.
Hey, Kev, is there a certain area or sector or anything like that you guys are looking at more favorably than others at this point?
Sure.
Just to kind of mitigate risk or anything like that?
Sure. I'd say a couple of things. I think that in a market like this, where, as Anthony, said extremely well, inflation is probably the number one thing out of all the things to worry about. At the end of the day, we are financial people, and that's the thing that probably has the biggest impact on your and my spending and our savings and our financial positions, but also companies. And I think what you really want to do right now is invest in companies that have just incredibly strong balance sheets. That means companies that have great cash flow. They're businesses that no matter what is going on in the world, people are going and spending money there. COVID was a great test for the Home Depots and the Costcos and the CVS's, just easy examples, and the Starbucks coffees. So I would say one, Louis, would be high quality companies. A lot of those companies pay good dividends, and those stocks are holding up much better this year anyway. So again, said simply, the businesses that are less affected by higher interest rates, higher inflation, pandemics, wars, all the things that we're talking about today. And we all know that, you know your own spending habits. So I would say those we call them high quality, balance sheet strong companies. Many of them pay good dividends. On the fixed income side, I'd say municipal bonds. Most of you on the call are probably familiar with what municipal bonds are. And remember, those are essential service bonds. Those are bonds that are essentially paying you interest. You're lending money to issuers that are running the essential services, the roads, the bridges, the tunnels, the tolls, the electrical systems, the water systems, the educational systems. Those bonds have taken a big hit because, again, inflation and interest rates doesn't spare anybody. When we have inflation numbers that are the biggest numbers we've seen in over 40 years, and the Fed has to aggressively hike rates to tame that, municipal bonds are going to get hit in the short term. But these are bonds that are paying their interest. We see minimal default risk in municipal bonds, whether it's local bonds, meaning the state, New Jersey, North Carolina, it doesn't matter where you are, or even national bonds. I'd absolutely be looking at municipal bonds. They've had about a 15% correction, and many of these are paying, even the highest quality bonds are paying close to 3%. Remember, municipal bonds are tax-free. If you're buying a bond from your own state, it's fully tax-free. If you're buying a national bond, a bond from another state, maybe you're paying some state income tax on that. But I'd absolutely be looking at municipal bonds. Our managers are taking full advantage of the discounts we're seeing there. So those are just two quick ones.
Good.
Kevin, they talked this morning on a program on MSNBC about be careful of high tech stocks.
I only heard half of what you said, Patricia. You said be careful of high-tech stocks. Is that what you said?
High-tech stocks, they said that there could be a liability in some of the big tech firms that would take down other tech stocks.
Could you guys hear? I'm not hearing great at what Patricia's saying. I heard high-tech stocks. I mean, I'm not exactly sure. I couldn't hear you that well. I don't know if it's.
Sorry, they said that there was to
That's
be
better.
careful of tech stocks because there was a volatility, and that if the major tech stocks went down, then other tech stocks could follow.
Sure. Well, let me comment on that. And I'm going to pick on one thing you said. Number one, and I'm going to take liberties here. Whoever they is, I'd like to know. I hope I'm good. I'm happy you smiled and you weren't like, who's this mean guy, Kevin? No, I mean, everybody's got opinions, Patricia. You know that.
Oh yeah.
Look, there's no question that there are some, we all know that technology stocks have been great performers for so many years. And remember, the word technology simply means products, services that change the way we all live. Young, older, it doesn't matter where you live in the world. This affects every industry essentially is technology, if you think about it. The car you drive, the doctor that operates on your knee, the way you cook your food, the way you pick your television shows, movies, everything is technology. But yes, when interest rates make inflation rise, there's no question that analysts in our industry, they reevaluate companies' future cash flows. And there's some tech stocks that out there that don't have strong balance sheets. Amazon's got a strong balance sheet. Microsoft has $300 billion in cash. Google's got a couple $100 billion in cash. So what companies like mine do is we reassess, who's strong and who's not. So there's no question, to your point, it happens to be a more volatile sector, but it's also a sector that recovers very quickly too. Once we get a sense of, all right, let's say inflation tames down to 3 to 4%, and long-term interest rates are more in that 3 to 4. What companies are in great shape and what companies won't be? And there's no question, there's some tech-type names, some companies that simply have an app that was a great idea for a little while and really going forward doesn't really have much monetization opportunities. That's where we reassess. We do think that some of the tech names that did so well, especially during COVID, have been oversold. Names, I'll give you one in the corner I saw here, Chewy.com. I don't know how many of you have dogs. I'm sure everybody's got dogs and cats. That company did so well because during the pandemic, everybody started buying their food through them. Well, the reality is people aren't stopping. Walk around your neighborhood and you see the recycling boxes everywhere. That stock had absolutely took off a couple of years. It's down like 80% off of its high. I was on a call recently where our mid-cap growth manager said, it's really silly that they don't see the growth that a stock like that has. Just taking an example, I know they reported good earnings today. So I think we reassess those that are really, really good and those that got ahead of themselves. That's all. But I wouldn't stay away from it. And, back to the financial planning point I think I've been making earlier is, although tech stocks are not for your money, you might need that principal next year, next 2 years, because they're always going to be volatile. But we are big believers. Innovation is kind of the word that it's a buzzword we use a lot in our industry. That is always bullish. During good times and bad times, there's technologies that are coming out that are always going to change the way we live. That never changes. So to your point, back to your original question, not to be long-winded, yes, they are absolutely volatile. Be careful. Don't just buy something because someone says, oh, you got to buy this stock. It does this. And it's already up 300%, but it absolutely should have a place in some of your longer-term money.
And I would actually just kind of add to that. Believe it or not, you look at what's happened, I'll say in the past, like 30 days, right? I mean, it's actually a good thing, right? Because prior to the past 30 days, you didn't see Amazon really sell off, right? You didn't see Google sell off. You didn't really see Apple sell off. And literally in the past 30 days, the three biggest companies in the world, basically, right? Well, I mean, Google or Apple was the first $1 trillion company or approached $1 trillion company. I mean, they got more cash than some countries and some global economies. Yeah. Nothing has changed with Apple, but Apple is now off at I think at its high, 27% for the year. Like, why? Right? But we actually want to see that because when that starts to happen, usually means it's usually, mom and dad and grandma and grandpa that are doing that selling. And that usually means we're pretty damn close to the end.
Yep.
Well
said.
They
I'm going to jump everybody. And I don't mean
Thanks, Kevin.
I got to get to a 5:30. But thank you so much for your time. And Anthony and Lou, you guys are the best. You know where to get a hold of me. And all the best to everybody. Great to see everybody today.
Thanks, Kevin.
Thank you.
Appreciate it.
All right. Thank you.
Yeah, that usually means that we've reached a point of what we call capitulation, panic selling. Everybody's just unloading everything. And when that starts to happen, that generally means you'll find yourselves, I don't know, within 5 to 6% of the eventual bottom. So, our feeling is that it's been painful. The good news is, I could speak for Pat. She's got 3 or 4 accounts. The rest of you, the same thing. You guys got more than one account. You have more than one account for a reason, right? I mean, we don't just put all your money in one place. And, we know that there are different buckets. There's that immediate money. There's the intermediate money. There's the long-term money. We invest it differently. So the good, so while we are not immune to it, we've been able to buffer it. But we truly and firmly believe that we've seen the worst of what we're going to see. I'm not saying that we've already bottomed. We might not have, but we're pretty close to it. And a month ago, I was not very optimistic about the world, and I'm much more optimistic, as to where we are right now. Lou will tell you, I'm different coming into the office now than I was, 45 days ago.
Definitely got more gray over the last month. I'll tell you that much.
Yeah. I know we kind of went over a lot. I mean, I'd really just kind of want to leave the rest for questions and answers. I mean, it's not rocket science. The one thing I will say, I said it before, we've been here before. It's not the first time. It's certainly not going to be the last. We'll be here again. But history does tend to rhyme. So, if the past, is similar to the future, then we'll be out of this thing before you know it. And then we'll move on to the next problem.
You said it pretty well, yeah. Not really much to add there. So.
Any other questions? No? All right. Well, that's all I got.
Thank you.
All right, guys.
Thanks a lot.
Thanks for being on the call. Appreciate it. And obviously, you guys always know where to reach us if any questions, concerns, anything like that. All right. Thanks again.
Everybody, take care. Thank you.
Okay.